Now that we have discussed the basic format of the income statement, here we have gone by an assumption that all the items here would be recurring in nature. In fact, we have not included any non-recurring or non-operating items. And there is a measure or there is a way in which these items are included. So in this set of video tutorials, we'll discuss how these non-operating or non-recurring items are included. The ones which we are going to discuss are as follows: unusual or infrequent items. We will discuss what is discontinued operations. We will look at what do we understand by extraordinary items and how they are included. And last but not the least, we will also look at how changes in accounting principles or estimates affect the income statement. And since these are non-operating or non-recurring items, let us now look at what these terminologies mean and how they are included in the income statement. We've already worked in sheet 1 with the income statement that we already had. So let me copy this income statement in sheet 2 and clean this up. Now for us to take it ahead, let me define some jargons. The gross sales here is known as top line, and anyone who refers to the top line essentially is talking about the gross sales or the turnover of the company. Profit after tax is actually known as the bottom line. So this is bottom line and gross sales is top line. Now when we talk about these four items can be above the line or below the line. So which line are we talking about? The line which we are talking about is profit after tax. So these items here can be included above the line, which means above the bottom line, or below the bottom line. Okay, so when we are talking about this, we'll refer to them as above the line or below the line. Now let us look at what these items actually mean. The item which is described as unusual or infrequent would be that unusual actually means that an item shows or possesses a high degree of abnormality, and an item which is infrequent would obviously mean that this item doesn't happen frequently and may be a non-recurring item. So an item which is unusual or infrequent, an example could be something like restructuring costs. Restructuring can be related to business realignments or organizational restructuring. So restructuring can have a lot of costs associated with it, so that would be unusual or infrequent. Something like impairments of assets or write-offs, these can also be unusual or infrequent items. Sale of assets or investment subsidiaries, these can also be unusual or infrequent items. Now that we have understood what this actually means, how are they included? These items are actually included above the line. So above the line means it will come above the PAT. The place where you will find this item is actually below the EBT. So above the line, above the bottom line for sure, but this is below EBT. I will rename this EBT as recurring EBT, because this EBT is because of the fact that all the items which were above this are recurring in nature. So that's why this EBIT is called as operating profit, and this is earnings before tax. I've inserted an item called recurring. Now below this I'll insert two more lines, the unusual or infrequent items, assuming it to be, let's say 30, and instead of recurring EBT here, I'll call this as just EBT. And this EBT would be equal to 300 minus this 30, which is the assumed unusual or infrequent item. Let's assume that this was related to the impairment of assets. So considering this unusual item, the EBT comes out to be 270. Please note here that the taxes have not changed accordingly, because the taxes that you pay essentially is on the earnings before tax. Earlier it was 300, on which we were paying $100 as taxes. Now it is 270. However, the taxes have not automatically adjusted. So I'll keep this 100 as constant for the time being. Please note that we will learn how to normalize an income statement later from the point of view of analysis. So this tax also gets adjusted for For the time being, I'm skipping this as such, and the profit after tax actually comes out to be 270 minus 100, and this is equal to 170. So the bottom line obviously gets reduced because of the unusual or the infrequent items. Now coming to the second thing, which is the discontinued operations. Now discontinued operations essentially is related to a business which has different segments. Let's say they had 4 segments. This business has 4 segments, A, B, C and D, and let's say this year they have discontinued D. Now what we note here is that this ABC is definitely going to be there for all the future years. However, D has been discontinued, so it will not be present in the future years. So this is again a non-recurring item if you look at. So any income associated with this segment D is actually called as a discontinued operations or income from discontinued operations. And where exactly it is written in the income statement is actually below the line. So where is below the line? Actually the line is profit after tax, which is the already calculated line. Below this, what we do is we include the term called income from discontinued operations, and this is actually reported net of taxes. So since we have already calculated taxes above this for the continued operations, income from discontinued operations net of taxes is reported below the line, and let's assume that this was around 50. So this is how it gets reported in the income statement. The third item, which is very interesting again, is the extraordinary item. Extraordinary items are defined as something which is both unusual and infrequent in nature. Now if you look at these terminologies, it may sound a bit confusing here. Unusual meant abnormal, and infrequent means it doesn't happen on a frequent basis. On the top, when we were talking about unusual or infrequent items, the keyword was or. So the item which are included here in line number 18 doesn't show both the attributes, they show only one attribute. So impairment of assets is unusual, but it is frequent. Many times companies can, or the assets may get old and they may lead to impairments, so this may actually happen. So that item can be a frequent item, but it's an unusual item. However, extraordinary items are both unusual and infrequent. Now just to give you an example, what would these be? Let's say an earthquake, a loss due to earthquake. This can be unusual and an infrequent item. Let's say if you have not insured your factory, losses or which are uninsured would be definitely unusual and infrequent. Other examples could be tornadoes or eruptions, that can also be a part of the unusual or infrequent. Maybe another example can be that seizing of assets by the foreign government. You have assets across multi countries, and in one of the countries your assets get seized. So any losses associated with those seizure of assets by the foreign government can also be classified as unusual or infrequent. So those are called as extraordinary items. So extraordinary items are again reported below the line, and these are included here, extraordinary items, and these are net of taxes. So say for example here in this case there were no extraordinary items, so hence it was 0. So we have just taken this as an example.